I have to say the inspiration for putting this together is my good friend and co-author on many things, Steve Malpezzi. Steve and I wrote a book on housing policy together about 15 years ago. It's actually people read. It's always surprising when I write something that people read. But also Morris Davis at Rutgers worked on this. So this is a 3 real estate center collaboration. And as I think some of you know, I spent a lot of time at Wisconsin before I was here at USC. So I could claim 2/3 of the institutions. Okay, so just some disclaimers. That's disclaimer number 1. First principle, when contemplating the US tax code, if you're not confused, you're not thinking clearly. And that's particularly true of this new tax act. So one of the things about this tax act that's going to be a challenge for your tax folks is it was really badly drafted. And by that, I'm not talking about, is the policy good, is the policy bad? Spoiler alert, I think the policy is bad, but leave that aside for a second. If you look at, for example, the Tax Reform Act of 1986 that came out of the Reagan administration, that was a really well-drafted tax law in the sense that people sat down, and it actually came into existence with something called Treasury 1 in 1984. That was the original version of it. The Reagan administration, working with Congress, spent 2 years refining it, sort of having it tidied up. So when the bill finally passed, okay, say what you like about it. I know that a lot of people in real estate didn't like it. I actually thought it was a magnificent piece of legislation. It was clean. It was fairly straightforward to understand what was in it, to the extent you can ever understand such things in a tax code. This bill, as I'm sure you know, was sort of drafted in about a month. And there were like comments written in margins that got into the law. There's stuff that didn't get into the law that was supposed to get into the law. So from just a standpoint of drafting the bill, this thing is a mess. And the implications of that are not going to be clear for the next year or so, but nevertheless, that's why no matter how carefully you read it, you're going to be confused, because there's stuff inside of it that contradicts the legislative intent that Congress said it had when it passed it. I'm going to talk about some of that. Okay, so next thing, I just have to say I'm an economist, so are Steve, so is Morris. We're not tax advisors. The description herein of the provisions are preliminary and our best interpretations to this point. We make mistakes, I am sure. Don't be your own lawyer or your own tax advisor. Find professional help that does nothing else but do your tax returns. So I am someone who testifies before Congress on tax policy, so I think I know a fair amount about taxes. I don't do my own taxes. So this is not hypocrisy. This is for real. Okay. Other thing is we're academics. We do stuff because we like doing it. I mean, we get decent salary to do what we do, but the point is, this is not consulting, so feel free, we're going to share this with everybody. Feel free to share it with other people, but don't try to make money on it, okay? I know nobody in this group would, but there are people who I know. In my career, I have had people lift my material for me wholesale and then sold it as consulting product. I really appreciate it if people don't do that. Okay. If you use them, we would have, and you're welcome to use it, but please let us know if you do, because it then makes our life worth living. And to the extent you can find mistakes, let us know. Okay, so presentation. Taxes, some basics. What about state and local taxes, which is a very big part of the change in this law? A review of the Tax Cut and Jobs Act of 2017 in a comparison to the previous code, and then we're going to talk about real estate with a focus on pass-throughs, who gets the cuts, and we may get time to these last two, we may not. So short answer to these two, will it increase investment? Maybe. Hard to be sure. Will it increase GDP, wages, and incomes? I am doubtful for the simple reason that the economy is right now humming along so much, I don't know how goosing it more is going to get you more GDP. Simple as that. If we did this 10 years ago, yeah, I think if you would have passed this law 10 years ago, would it have increased GDP, wages, and incomes? Yeah, it probably would have. But right now, I'm actually not sure why we're doing this right now. Okay, so some basics. So first of all, some principles for taxation. What makes a good tax? And I know everybody in this room is going to have a different view about what the right amount of taxes should be. I'm sure there are people around the table who think, okay, pay for the police and the army and otherwise leave me alone. There are other people who think they like social welfare programs, they like social insurance programs. We're not going to get into that fight here today, okay? But just say you have to raise a certain amount of revenue. What's the best way to do it? And some principles that we care about are, first of all, we should tax people with similar situations, similar amounts. If you're in the same economic position, you should pay the same amount. That's called horizontal equity. We should tax net income, not gross, so permit the deduction of the cost producing the income. Okay, so how does the taxation of real estate and other assets stack up with respect to this ideal? So what would an ideal tax look like? Of capital is income would be fully taxed, current income would be fully taxed. Capital gains would be fully taxed on accrual, which means that you wouldn't wait for people to sell stuff, you just revalue it every year and tax it based on the appreciation, or reduce taxes based on the depreciation. But you would have deductible this thing called the opportunity cost of equity. So if your risk-adjusted return on an investment is 8%, you get to deduct 8% of the investment, which would reduce this by a fair amount. Interest would be deductible. Maintenance and repair and recurrent expenses would be deductible. State and local tax would be deductible. So the point is, we're taking into account all income, we're taking into account all expenses, we're including the opportunity cost of capital. We're deducting the expenses from the income. That would be the foundation of a tax that would be the most efficient income tax that we could have. We're never going to get this. Why can't we get this? Well, figuring this out would be nearly impossible on buildings. Right? Do you trust appraisers to know what the value is from year to year? I don't think so. And we could never figure this out. Okay, so in light of this, this is in an ideal world where we know everything, we're not going to see this. So what's the second best? We just don't tax it. We don't tax the income, but nothing is deductible. Okay, so this is, if most economists were thinking about how do you tax capital, this is what we would do. We wouldn't tax any of the income, but we wouldn't allow your expense to be deductible against other kinds of income either. What do we see? Well, in non-residential real estate and rental housing, current incomes are taxed. Nominal capital gains are taxed on realization. The opportunity cost of equity is not deductible. Interest is deductible. Recurring expenses deductible. State and local tax is deductible. On owner-occupied housing, if you own a house with equity, your own house, you're basically paying yourself rent. You're not taxed on that. So that's a tax preference. Okay? Think about it. You own a house, your neighbor owns a house, you swap houses and rent to each other, now you suddenly have a tax event where you didn't have a tax event before. Same living arrangements. So imputed rent is not taxed. Capital gains could be taxed, but rarely are because there's of the exemption of capital gains. Opportunity cost of equity is not deductible. Interest is deductible. Expenses are not deductible. State and local taxes are deductible. Okay, property taxes are deductible. This is as of through 2017. Corporate plant and equipment generally taxed twice, once at corporate income and again when distributed to shareholders. Capital gains are taxed on realization at a preferential rate. Again, not deductible, 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 deductible. So the point is, if this is what economists think of as ideal for the way to tax capital, whether you're looking at rental housing, owner-occupied housing, or corporate plant and equipment, we're not close on any of them. Who pays taxes? This is, as we have these debates about tax policy, we tend to think of who pays taxes in terms of who writes the check. That's not the right way to think about it. Okay? Sometimes you could pass through taxes to somebody else. So you write the check, but you're not really paying the tax. Sometimes you can. And what it boils down to is, are you footloose or are you not? Right? If you're sort of stuck doing something, you're going to bear the burden of a tax, regardless of who writes the check for it. So if you're a consumer and there's something you absolutely need to have, we say your demand for it is inelastic. No matter what the price is, you're going to buy it. Parents who need diapers. Okay, let's say there were a diaper tax. Okay, it's the middle of your night, your kid runs out of diapers. You go to wherever you go to buy, it's been a long time for me, to buy diapers. Okay, that tax can be passed, if there's a tax on diapers, that tax can be passed on to you. Whether it could be paid directly by you, that's the sales tax, or it could be, in Europe, it would be called a VAT. It wouldn't be paid, it would be paid by the seller of the diapers, but basically they would just increase the price enough to pass on the cost to you. So there's a difference between incidents, legal incidents, and who actually bears the burden of a tax. And this is a list of different ways to think about incidents, but the way I think about it is, as I just said, if you have a producer or a consumer who's sort of stuck doing what they're going to do, they tend to bear the burden of a tax, regardless of who writes the check. If you have a consumer or producer who has a lot of options, doesn't really need whatever it is, or can move their production activity somewhere else, then they don't tend to bear the burden of the tax. So that's basically how to think about taxes. And this is particularly important in the corporate realm, because one of the great debates in economics is, with a corporate income tax, who even pays it? Is it owners of capital? Is it wage earners? Is it consumers? And again, the answer is it all depends. And we're going to come back to that. What have taxes looked like in this country? Well, until about 1913, it all came from tariffs, something that's in the news lately. Tariffs are a really bad way to raise revenue, in part because that means interest groups can fight among themselves and among Congress to say who gets protected and who doesn't. You don't have a level playing field, inevitably, when you're using tariffs as a way of raising taxes. The personal income tax kicked in 1913 with a constitutional amendment. It funded World War I, so it went up, it went down, but you can see it was about 5% of revenue. Then World War II came along, and it jumped to about 15% of revenue, 15% of GDP, rather. And then the second biggest source of taxes is FICA, the payroll tax, Social Security and Medicare. Okay, and as you can see, FICA is almost as large a share, well, not, that's an exaggeration. So right now, about 10% of federal revenue comes from the income tax, that's both corporate and personal, and about 5% comes from payroll taxes. So this payroll tax, which people don't talk very much about, is pretty important. Okay. How heavily are we taxed? Well, the answer is not that heavily by OECD standards. These are rich countries. These are all taxes, state, local, and federal. We pay about a quarter of our GDP in taxes. The OECD average is about 34%. Denmark pays the highest taxes. They pay more than half their income in taxes. Mexico pays the lowest at about 20%. Among countries that have economies that I think we would tolerate, Korea pays the lowest, quite similar to ours, a little under 26%. Canada, you know, which people talk about a lot, is about 30. Japan is about 30. So that gives you a flavor of how taxed we are. And we move around a lot in terms of how much we tax people depending on their income. So this is the history of marginal tax rates in the US. Again, going back to 1913. Just you can see it moves around a lot. It's just been cut to 37% from 39.6. This is what's happened to the corporate rate. Again, not jumped around quite as much. During World War II, the top marginal tax rate was 94% in the US. During the Eisenhower administration, it was cut to about 91. Almost nobody actually paid that tax because there were so many deductions in the tax code at that time. When John Kennedy was president, he introduced a 20% across-the-board cut. Lyndon Johnson got that done in 1964. Then you had Carter tax cut, I'm sorry, the next round of Johnson tax cuts. Then the Vietnam surtax went away, went down again, and then you had the Reagan tax cuts and the Tax Reform Act, which really reduced the rate from 50% to 28%. Economists love this kind of thing for the following reason. This gives us lots of experiments to look at. How does tax policy influence behavior? Right? It's these changes. These are not small changes. These are big changes. And so we're asking, do you see behavioral change in light of these big changes? Okay, I'm going to preview as we think about house prices, and housing is treated less favorably now than it was 3 months ago by the tax code. But how many of you folks are around long enough to remember Tax Reform Act of 1986? Okay, that had an enormous impact on the value of the mortgage interest deduction, right? Because it used to be worth 50 cents on the dollar of deduction. It dropped to 28 cents. How many remember house prices falling dramatically in 1986? Actually, they didn't. They didn't. They fell in the late 80s and early 90s in California when the California economy imploded. But no, if you look at 1986 to 87, you would expect to see a big impact on house prices, and you don't. I'm going to show that more rigorously in a bit. And then the other thing is the what we call tax thresholds are very volatile. The first of these, this blue line, if you look at the left, is the amount in today's dollars you would have to make to pay any federal taxes at all, federal income taxes at all. And when the tax code was initiated in 1913, you needed to make about $370,000 in today's money. That would have been about $40,000 a year at the time in order to pay any taxes at all. So when the income tax was invented, it was invented to hit rich people or high-income people, 1%ers. Actually, 400,000 is the 1% threshold today in the U.S., so it would be like 1%. As you can see, again, that's changed over time, and right now it hits you at about, depending on the size of your family, $22,000 a year is when you pay any taxes at all. Okay. The threshold for the top rate, again, it's moved dramatically. This is, again, $2016, the threshold for the top bracket. Right now, that threshold with, again, this 2017 Act has risen to $1 million. Okay, and obviously, again, these are very volatile, which gives us the chance to look at how tax policy influences outcomes. What about the 47%? Who pays no federal taxes? Yeah, 40% of people pay no federal income tax. But that by itself is incomplete and misleading. So this is the share of people's income that they pay in taxes when you look at all the taxes they pay. Their federal income tax, their payroll tax, state sales tax, property taxes. Okay, add them all together, divide them by their income. And as you could see, the bottom 50% pay a smaller share of their income than people higher up the chain. But this is the 1%, this is the bottom 50%. But everybody pays a good amount of their income in taxes. The bottom of 50% pay about a quarter of their income in all taxes. Very little in federal taxes, but between payroll taxes, which if you're accounting properly is 15%, because you should count the employer as well as the employee share of that, and state and local taxes. This is the effective tax rate by income quinto right now. This again is going to change with the new act. We get these data with lags, so unfortunately this is 4-year-old data now, almost 5 years old, but you could see effectively if you're in the top 1%, your tax rate is 34%. That means every dollar you have made, you've paid 34 cents of it in taxes. If you're in the middle, you're paying about 15%, and if you're at the bottom, you're paying about 2%, 2 to 3%. One thing, if you're curious about what this tax law has done to you personally, there's something called Taxim, T-A-X-S-I-M. I should make a slide for it. That's on the NBER website, and you can type in your information for 2017 and for 2018, and it will tell you what your taxes were under the old law and under the new law. And basically, in my own case, as the deal for me is, on the one hand, almost all my income is wage income. That's bad. I live in California. That's bad. But the tax rate for a good part of my income, the marginal rate for a good part of my income is lower. That's good. For me, it's a wash. I'm basically going to pay the same taxes next year that I paid last year, keeping income constant. But depending on where you are in the income distribution and other things, you may find that your taxes, most often will go down, but in a few cases it may go up, largely because of the lack of complete state and local tax deductibility. What do taxes do to the income distribution? Well, if we look at the top fifth of the income distribution, before tax they earn about half the income in the US. After, it's about 47%. So taxes are mildly progressive. They reduce the share of income the highest quintile owns. If you look at the top 1%, before taxes they make about 13.4%. After taxes, 11.5%. So again, it's progressive. If you look at the lower income people, after tax, their share of income is higher than it is before. It's not that their income is higher, their share of income is higher. So this reflects some progressivity in the tax code. Age, share paying by age. Okay, if we eliminate payroll taxes, young people, not that many pay federal taxes because of deductions. Old people, not that many people pay taxes. The people who are most heavily taxed are people between the ages of 25 and 65. No great surprise there. And again, this is the sources of revenue by GDP. Here's total revenue. Here's individual income taxes. Here's the corporate tax. You put them together. Again, they're about 50% higher than the payroll tax. But you could see for individuals, the payroll tax is about the same on average as the federal tax. All right. Now, all that said, there's basically one thing these guys agree on, which is that the corporate tax rate in the US was too high, among the highest in the world, if not the highest in the world. Now, this is a little weird in that if you look at, it's a great picture, isn't it? If you look at what's called our effective tax rate for corporations, it is very high by world standards, but it's not the highest. Okay? Why is that? Because the corporate tax system in the US has lots of deductions in it. Some of you may remember about 5 or 6 years ago, there was a proposal called SimpsonBowles. It was a proposal to reduce the federal deficit. It is something you may remember I spoke about and I was enthusiastic about. SimpsonBowles had the following tax treatment of corporations. You would basically cut the rate dramatically and eliminate pretty much all of the deductions, sort of going back to that first slide about principles. I really like that idea. So the marginal rate is too high, 35%, because that's influencing behavior. But then you shouldn't have loopholes that also influence behavior. So the reason, even though our statutory rate is 35, the effective rate is about 18%, is because of all of these deductions that may or may not make economic sense. The Republican tax plan that came out of the Ways and Means Committee about a year ago would have cut the rate to 20%, but would have eliminated almost all of these deductions that currently exist. What happened with the 2017 bill, which goes into effect January 1st, 2018, is that it cut the rate from 35 to 21%, but it didn't do anything with the deductions. And so the amount of revenue generated by corporations is going to fall by about $1 trillion over the course of the next 10 years, $100 billion a year, roughly speaking. Other interesting thing is if you look at how real estate is treated relative to plant and equipment, okay, and it's because of depreciation rules, real estate pays a much higher effective rate than buildings and equipment do. Okay? Why is that? Simple reason is the depreciation schedule for real estate are much longer than they are for plant and equipment. It's 27.5 years for residential, 39 years for commercial. Plant and equipment would often have depreciation schedule of 5 to 10 years. Very often, if you have that kind of depreciation schedule, you basically have no taxable income. think about a machine that lasts 10 years, but you get to depreciate it over 5. That's a pretty substantial tax benefit that you get out of the code. Real estate has actually been unfavorably treated by the tax code relative to other kinds of investments since the Tax Reform Act of 1986. The relative level of unfavorability has varied, but it has always been less favorably treated since the Tax Reform Act of 1986. That was an overreaction to the fact that in 1981, real estate was given very favorable treatment relative to other kinds of investments. So lots of money flowed into real estate that really nobody needed. And so Congress thought, well, we don't want that ever to happen again. So they wrote a law that was actually needlessly penalized real estate. They overdid it. This is what's happened to our corporate tax rate over the years. This is the effective rate. As you can see, it has been falling again, in part because of rates. Rates were much higher earlier, more recently because of deductions. Okay, now, I'm not going to spend much time on spending and the debt because I don't have a lot of time here, but just one thing to note is this is federal debt held by the public as a share of GDP. Because of the economic recovery, it was finally starting to flatten out. What is the maximum level that's okay is a question that nobody knows the answer to. I am pretty sure that having it go up in a time of economic prosperity is not a good idea. It was going to go up anyway. This is the CBO, what's called CBO baseline. This is, had the tax law not changed, what would have happened to the debt to GDP ratio. With this tax act, it goes up even more. So as you know, large tax cuts without offsetting spending reductions, actually then Congress passed a law that's going to increase spending. This is before that law was passed. This is just the effect of the Tax Act. And so I do worry very much about how rapidly the debt is exploding. And again, a concern I expressed while the past administration was in power as well. And again, particularly at a time, I think in 08 it was all right. When the economy was really in trouble, we really needed to backfill it. But we should have been leveling off, as I said, around 2010. I'd be way more comfortable if around 2010 we'd started flattening it out. But we didn't, and now we're making it worse. Does public debt have an effect on GDP? Well, there's a scatter plot of 20 advanced countries over a 30-year period, 40-year period, sort of looking at what's their debt to GDP ratio and what's their growth rate. And if you could see a strong this is sort of the regression line you get. So it's sort of downward sloping. Do you see a cliff? Not really. That's what I mean about it's really hard to know at what point it starts to matter. I just can't believe it doesn't matter. Okay, state and local taxes. So big surprise here. So this is personal marginal tax rates by state. And how many are surprised to learn that California has the highest top marginal tax rate in the country? No gasps? No, never would have known? Okay, that kicks in at $1 million. What I'll say is for people I'll call at the 1%, you're paying 9.9%, which is the relevant rate for most affluent people in California. But the top is 13.3. Okay, this is going to matter a lot in terms of the tax bill. As you can see, we have 8 states with no personal income taxes. One, Tennessee, has personal income tax on dividends and interest income, but not wage income. Here's state corporate tax rates. Okay, believe it or not, California is not the winner here. There are states that it's a little higher: Alaska, Pennsylvania, Iowa. Maine is a little higher, Vermont. But we tax our individuals and we tax our corporations at a pretty stiff rate. Okay, because the state and local tax deduction matters a lot, particularly to people who have a decent amount of income. So if you look at people with more than $200,000 a year, they write off about $13.4 million in mortgage interest. They write off about $50 billion in state and local tax deductions. Those are largely going away, as you know. The nature of state and local taxes in California is different than other states. I just want to compare two because they're sort of outliers. California, if you look at who pays them, If you look at the lowest income people in California, they pay about 10% of their income in state and local taxes. If you look at people making, what is this, 100 to 220, they pay about 7.5%. The top pay about 9%. The reason for that is, well, from an income stack standpoint, of course, the top 1% pays a lot more than others. If you look at sales taxes, they tend to fall with income, right, because you consume less of your income as your income rises. If you look at property taxes, it's kind of flat. At the very top, it's lower. So if you put it all together, California taxes are pretty flat across the income distribution. This is without the federal offset. This is without the federal deduction. Particularly for high-income people, it goes up quite a lot, from 8.7% of their income to 11.2% of their income. So this is going to matter to high-income people if you take this away from them, when you take it away from them. Florida is a whole other animal. Florida has no income tax. It relies very heavily on sales taxes. So here's the share of income tax going to, as a share of family income, it's 0 across the board. Because they use sales taxes, again, as your income goes up in Florida, the share of your income you pay in taxes goes down. And if you look at the difference between before and after the federal deduction, it's pretty small, okay, 1.9 versus 2.5 at the top. The reason being you're not paying that much in tax in the first place, so the deduction doesn't matter as much to you. Interesting thing, if we look at state and local taxes, how much of income they pay by income group. Again, here is California, this really big circle here. This is the share that lower income people pay. It's about 10%. This is the share that higher income people pay. Again, it's about 8%. So one of the reasons I think this bill is going to have less impact than people are assuming is the lower income people are probably not itemizers in the first place. And if they were itemizers, they're going to get a big benefit from the much bigger standard deduction that I'm going to show you in a bit. The higher income people pay less of their income in taxes and state and local taxes anyway. And so, again, it's not to say there won't be an impact. I just think it'll be smaller than some people think. How much does this matter? Well, this is the share that this map depicts the share of people who actually take a state and local deduction on their taxes. The dark states, Connecticut, Maryland, New Jersey, they have more than 40% of their taxpayers using this state and local tax deduction. The pale states, North Dakota, South Dakota, West Virginia, have the least share that take the state and local deduction. Okay, why is West Virginia so low? Is people have no income there. So when you have no income, it's hard to take much of a deduction. And then in the middle, you sort of have this interesting scattering. You have California, Wisconsin, Georgia, Washington, Oregon, New York, Massachusetts, Virginia. Utah being in there I find kind of interesting. So among these middle states, then the question is, for those that take the deduction, how large is the deduction? In California, it's about $17,000 a person. That's the average size of the deduction. Okay, so now they're going to be limited to $10,000. So what does that mean for a Californian in the middle tax bracket, which will be 27%? 17,000 minus 10,000 is 7,000. Take a quarter of that roughly. That's about $1,700 more a Californian is paying because of the limitation of the state and local tax deduction. $1,700 a year. Okay, but against that, they're again getting a tax cut because the rates are lower. So they may wind up a little ahead, they may wind up a little behind. In terms of their position vis-a-vis other states, it's worsened. But the question is $1,700 a year enough to change behavior? You're going to say, you know what, that's the final straw. That's $1,700, I'm moving to Texas. It might be. We don't know. But that's the way you got to think about that question. And the interesting thing, but from a behavioral standpoint, since the typical Californian, when they look at their paycheck at the end of the month, it's not going to really change. Because this other thing, they think of the thought process they have to go through. oh, let's see, yeah, my taxes are the same, but if I lived in Texas, they'd be lower because I'd still get the state and local tax deduction. Okay, everyone in this room thinks that way. I know you do. Don't deny it. You think that way. But is a typical physician, for example, going to think that way? And my guess is not, because I found it really interesting. So my wife's a doc over at UCLA, and then they did a retreat a couple of weekends ago about sort of career and benefits and so on. How many physicians in the UCLA geriatrics practice do you think really understood their benefits well? There are 22 docs in the practice. Yeah, and who was that one physician? She was astonished how nobody knew. They didn't understand their pension. They didn't understand their health. They didn't. It was just sort of passively, yeah, whatever. Right? Now, for example, all of the Lusk staff knows that they better max out on their 401k contribution from USC, because that's money you're giving to USC if you don't do that. We have professors at USC who don't understand that. So these are not like average people. These are sophisticated people. And so 1,700, if I move to Texas, I don't know. Maybe it makes a difference. I don't know. My guess is not. OK, Tax Cuts and Job Act. Let's look at it, some of the more specifics, comparison to the prior code. And I have 10 minutes left. So just a few things. First of all, of course, we have this tweet. And anybody been fired over Twitter in the room? Just curious whether that's... OK, is it the biggest tax cut? No. This guy did the biggest, which I'm sure you know. This is the right way to look at tax cuts, which is what share of GDP are you cutting? This was the Reagan tax cuts in 1981, 3%. That's an enormous tax cut. Think about a good year of GDP growth is 3%. So that's like 1 year of GDP growth in 1981. Again, we were in a very serious recession in 1981. Tax cutting made a lot of sense at the time. I think the general view is that it was a successful policy at the time. Immediately after World War II, right, we were decommissioning an army, a navy, Air Force. Well, we didn't have an Air Force yet, Army Air Corps. So big tax cuts then. This one is a cheat, 2013. You're saying there was a big Obama tax cut. Well, the Bush tax cuts would have expired had Congress done nothing about it. And so the tax code that came along in 2013 restored many of the features of the Bush tax cuts that would have expired. And so that's where that tax cut comes from. So it's relative to what's called relative to baseline. These are the Kennedy LBJ tax cuts. This is the size of the current tax cut, about 1% of GDP. So it's a real tax cut, but it's not remotely the biggest ever, which again is why I kind of wonder how much it matters, although again, I'm worried about that the deficit is increasing. One way to think about it is, it's sold as a $1.5 trillion cut, but that's $150 billion a year because it's over 10 years. The economy is an $18 trillion economy, actually getting close to 19. So how big is it? I mean, it's real. It's tax cut, but hardly the biggest. But who gets it? And this worries me, not from, and we could talk about social justice some other time, but from a macro standpoint. If you looked at the Reagan tax cuts, tax reform in '86, for lower income people, more than 70% got a cut. For higher income people, it's 60%. The Trump tax cuts, lower income people, if you make before 40,000, yeah, you got to hit like 50,000 a year before it's likely that you get a cut. But all high income people get a cut. And if you look at change in after-tax income, again, Reagan tax plan really boosted the income at the lower end of the distribution, barely touched, the Trump tax plan barely touches the lower end. Again, kind of they're the same at the higher end of the distribution. Reason that worries me, low-income people are the people who consume their income. High-income people don't. And in a world where retail is having issues, that worries me. And the other thing is the Tax Reform Act of 1986 actually improved deficit conditions. Ultimately, Trump plan won't. Okay, specific provisions. Okay, this will bore you to tears, so I'm not going to go through this. But in the slides, this will take you through this summarizes all of the provisions. There's one mistake in here, which is healthcare, where it says 7.5%, it should say 10. Where it says 10%, it should say 7.5. I will fix that. If you're divorced, you're really unhappy if you were the payer of alimony. You are very happy if you're the recipient of alimony, because it used to be alimony was tax deductible for the payer and taxable for the recipient. Now it is no longer tax deductible for the payer, and it is not taxed for the recipient. And given who the president is, it just stuns me that this got into the tax code. That was supposed to be a little joke, but I guess it didn't go over very well. But you can work your way through these. Again, a couple of really important things, though, are one, now your state and local deduction is limited to $10,000. The standard deduction has been doubled from $12,000 to $24,000. As a result of that, we think only about 10% of people will itemize now. Used to be 50%. And so that means housing is less favorable than it used to be, because most people with mortgage interest are not going to deduct it anymore. They just get the deduction. So should it matter? Oh, AMT is still there, but not as biting as it used to be. Will the new law affect house prices? This is a graph that I created a few years ago for the Bipartisan Policy Commission as we were looking at real tax reform. And what I did is calculated an after-tax cost of capital by city. And the way to think about this is, in Texas, you don't pay income taxes. In California, you do. So a mortgage interest deduction is more valuable in California than it is in Texas, right? Because you get to deduct, for state tax purposes, mortgage interest in California, along with the federal tax deduction. So you can get this difference across states because of difference in state tax rates, and difference across time because tax policy changes across time. Okay, and so I computed an after-tax cost of capital for every large city in the US, something like 200 of them, for several years. And I plot that against the rent-to-value ratio, which is sort of, think about that as a dividend yield, or the inverse of a price-earnings ratio. So if the after-tax cost of capital drives house prices, that's the argument about the mortgage interest deduction, it should be the case that for a given rent, housing becomes more valuable as the after-tax cost of capital falls. Get the idea, right? It's like it's like the cap rate on housing. If the cap rate falls, it should become more valuable. Do you see any correlation of anything in this picture? Okay, and the reason these are two different clouds is they're different years, but there's nothing there. Okay, this is the easy way to do it. I fancied it up in all kinds of ways. I can't find any evidence that the mortgage interest deduction has much influence on house prices one way or the other. So this idea that house prices are going to collapse if you scale back on the mortgage interest deduction is just silly. It's not silly. Actually, it's a reasonable I shouldn't have said that. It's a reasonable hypothesis, but the data don't show it. And an easy way to look at it, again, in 1986, the value of the mortgage interest deduction dropped by about half. And if you look at house prices, you can't see any discontinuity in house prices at that point, which you should see. So Doreen's point, yeah, California house prices crashed in '89, but that's because Raytheon was laying people off, and the economy was crashing. That wasn't about the tax code. Commercial real estate. Special provisions from real estate. First of all, exempt from corporate limits on tax deductibility if you pick a certain depreciation schedule. Tax-deferred exchanges remain while they've been eliminated for other industries. New depreciation schedule. And rent and mortgage interest income are taxed at preferential pass-through rates. These are the big provisions. Treatment of pass-through entities, 20% deduction for qualified business income. Deduction is limited to the qualified business income. You can't use it against other kinds of income. if your taxpayer's income is above, for an individual, 157, for a married couple, 315, the deduction is capped at 50% of W-2 wages paid. That means if you pay people in 1099 and you make more than 150,000 a year, you get no benefit out of this. You have to have people on your payroll as employees in order to get a benefit out of this. Or 25% of W-2 wages plus 2.5% of the acquisition basis of depreciable property. And that's why there's, if you're a doctor, you should run out and buy your building, because that depreciable basis can determine the extent to which you can use pass-throughs in your business. These provisions expire in 2025. REITs get the 20% pass-through for now. Again, remember, REITs aren't taxed at the corporate level, but when the dividends are paid out, they'll get a 20% preference when they're passed along to individuals. Compared to the C Corp, under the old law, you would pay 35% at the corporate level, and a maximum of 25% for dividends. That comes out to 48% because 65% of 20 plus 35 is 48. It now comes down to 36% because of the 21% at the 20. So again, REITs have a preference relative to other corporations, but not an enormous one in terms of dividend payout. Again, this all expires except for the 21% rate for a C Corp in 2025. Depreciation is confusing. This is where the drafting didn't go right. And this is kind of a big deal in real estate. Currently, we have I shouldn't say currently. Before January 1st, we had 27.5 for residential, 39 for non-residential. Qualified improvements to leaseholds, restaurants, lodging, retail have shorter useful lives. Under some conditions, you could take qualified expenses, et cetera. This is the old law. Okay. What are the modifications? Well, first, if you elect to exclude the interest deduction, you have to use this new depreciation system, 40, 30, 20. 40 for non-res, 30 for res, 20 for qualified improvements. So if you're building a shopping center and you're putting in tenant improvements, even if the lease is a 5-year lease, you have to expense it over 20 years. You have to depreciate it over 20 years. The Senate proposed shortening this, but it didn't appear in the bill. So people think this should have been wrong, but we don't know because it's not in the bill. The other thing is immediate expensing, and I know Jim asked about this, this is my understanding of the bill, is it says specifically it has to have a useful life of less than 20 years in order for something to be expensed. Now, think about what a big deal this would be if you could expense real estate at the time that you acquired it. That would be an enormous deduction. But real estate has a useful life of more than 20 years, at least based on that alternative depreciation schedule. So my interpretation, though I could be wrong, and we don't have IRS guidance yet on this, is you cannot expense real estate as you can plant and equipment with lives of less than 20 years. Again, what about improvements? Not in the bill. It's silent. So we need technical corrections legislation, which is what we've had in every past tax bill. What do you think are the chances that Congress gets a technical corrections law passed? It's probably pretty limited. Some other provisions: carried interest remains, but less generously. Contributions to corporations by a governmental entity are now taxable at fair market value. Net operating loss usage is partially limited and no carrybacks, but we still have 1031 exchanges for the real estate, but not the personal property. So you're going to have to divide fixtures and chattels. Okay. How well does real estate do relative to other industries? Well, this is the expectation in tax paid as a result of this bill. See, mining makes out like a bandit. Finance insurance, a little better than average. Real estate does worse than average. Why is that? Well, it's because so much of real estate was sheltered by depreciation before that depreciation is not quite as generous as it was before. And so, long story short, here's an example I put together. Before, real estate would earn an after-tax return on equity of 8.72%. This I'd consider kind of a typical real estate deal. The ROI under the new law was 8.27. Under the new law, before tax is 8.72. Under the old law is 8.21. Under the new law is 8.37. Reason for the change? Well, there's a lot of sheltered income before and after. There's the interest on the debt, and there's the depreciation. To the extent you use debt less, the difference is going to look a lot bigger. But I thought the 65% is kind of typical because people usually, when they refinance back to something like 65% of their loan. Key assumption, all your expenses are deductible, that you have enough income to deduct your expenses. If you don't, again, there are some carry forward provisions. There's no carry back provisions. How you get to use that, again, is going to affect that rate. So I'm out of time, really. And so who benefits from this? Well, Ernst & Young, Price Waterhouse, Deloitte, KPMG. You know, who gets the cuts? I'm sure you've seen this. It does tend to be loaded toward actually kind of the middle. So people making, this is just the impact on revenue. So people making, because there are a lot of these people, they're going to get the biggest total cuts, not the biggest per capita. This is what happens to average taxes by income level. Is basically at the bottom there's slight increase, 0. You know, high income people are going to get pretty big tax cuts here. They don't spend them. Will it increase investment? I'm just going to repeat what I said before. It depends. To the extent you think investment is footloose, yes. So if you think businesses are constantly rethinking where do they put their plant and equipment, yes. To the extent investment is not footloose, no. Because it's there or it's not there, right? You either do the activity or you don't do the activity. And it's profitable or it's not profitable. So similarly, will it increase wages? Well, it depends on, is labor footloose or not? If labor is footloose, yes, wages will go up. Means that companies have to compete with each other and they will use that money to keep their workers. If labor is sort of stuck in place, no. So think about Silicon Valley. Will this increase wages in Silicon Valley? Yes, because workers are very footloose there. They can go anywhere. Will it increase wages in West Virginia? Probably not, right? Where are people going to go? Because they don't have the skills to go somewhere else. And I look forward to seeing you soon.